Guys, it's raining where I'm at. It's Saturday, and so I thought I'd just make a video while I'm just kind of hanging out at home. And in this video, I'm going to cover two things. One, I want to point out a trade idea that a subscriber just pointed to me. I'm interested in it, so on Monday I'm going to be looking at kind of how that's going and maybe taking a position there. So I'm going to point that out, let everyone know about that one. But first, I want to start out with another concept that another subscriber was talking to me about, why I'm bearish basically, and when am I going to become bullish. And I hear this a lot. This is when you're bearish, you have to understand that 80%, probably more, 90% of people are, especially retail, are they're essentially bullish they're bullish all the time, and they're always bullish usually when the stock market's going up. And then usually they're bearish after the market falls or has a crash. So that's just how it works. People, it's a psychology thing. As the market's going up, they're bullish. They think the good times are never going to end. And when the market's plunging, they're bearish, and they think the bad times are also never going to end. And so, as the market goes up in 2020 so far, I hear a lot of people saying that, why are you bearish basically, and questioning my thesis and things like that. That's okay. That's perfectly acceptable. I understand how that works, but most people just look at price. A lot of people look at price. They see price moving, and a lot of the bulls, they see the tech sector. Most bulls are invested in FANG in one way or the other, I would say. Because that's the sector that's performing, tech basically in general. And so they see that tech is going up, and they think everything else must be going up as well. We're in a huge bull market. It's clear and obvious. And it's really kind of tunnel vision. They get narrow vision in tech. And I want to kind of lay the groundwork there that, I understand that. I know that when you look at your account every day and it's going up, you feel like everything must be going up, but that's just not the fact of what's happening. And so where I'm going to start out today with this video is the S&P 500. And what we're going to look at here is the monthly charts. So big, huge, lifetime patterns, basically. We're looking at, this really goes back, the SPY really goes back to 1993. So we're going to cover the last couple market, big bull, the bull markets and the big bear markets. We're going to cover those and look at the patterns that we saw back then. And I want to point out what we got going on. So here's your bull market of the 2000, kind of the dot-com bubble, basically. Now, what we saw here, I want to look at, we started to build negative divergence right there in the S&P 500, which really didn't diverge until about right there, 1996. And the market continued higher with negative divergence up another about 100% before the market really topped out. So negative divergence was intact, and the market did continue higher. Now, negative divergence is not it's not everything. It just tells you to tune in. And one thing, so the way I do it is when you start to see negative divergence building, then you look for trend line breaks in the pattern that you're looking at, whatever time frame. So in this monthly pattern here, you would want to, you'd notice that we had a negative divergence back here in 96, but you'd say, okay, we have negative divergence, trend is probably going to break. And if you're long, you can stay long, but be on the lookout for a trend break. And ultimately, it never really came. You never really had that monthly close below the trend. You really started to establish the trend right here back in 96. So the trend was established. It was negative diverging, but not below trend, and it just continued above trend the entire time. So that's one, you didn't have your trigger or sell signal until all the way up here in 2000, and then you got it when you got that monthly close below. So that's one way to treat that. Now, if you go back to the last crash, the 2007 or 8 Great Recession, then you can see we started to build negative divergence right there. There's your negative divergence. and we made a new high right there on October of 2007, kind of a marginal high, and it was, when we were, if I zoom in, you can see the intra-month price action was just marginally higher. You see the wick right there on that month. So we were making marginally higher, but diverging. It was negative divergence, which told you that this price up here is likely to fail. And then you got the failure. So then what you'd want to look for is a trend line break. And the trend is, for this one was something like this on the monthly. Probably looks different on the weekly. So this didn't break until here. Again, these big patterns, these monthly patterns, these are, I don't use the monthlies to enter positions. I use the shorter time frames, but these will give you kind of the bigger trend, ideas. So then we broke trend and we had the, financial Great Recession. Now going back, or now with the pattern we're in now. So what do we have? Well, we have big negative divergence right here. Here's your actual negative. Here's where you put in the negative divergence right there, September 2018. Right there, when we made a new marginal high. It's very common to make a marginal high, and again, these are monthly charts, so it was quite a bit of range, but for this monthly chart, it's a marginal high. So we made marginal high right there, and that says, okay, tune in for a trend break, and that's when we got the trend break in 2018, and we've been below trend the entire time. It's not a coincidence that we broke this trend, this bull market trend from the last bull market when we put in negative divergence. The negative divergence is showing that there's a lack of momentum and a lack of enthusiasm essentially, and there's less and less buyers at the same rate as before. So you're losing momentum, and then you get the trend line break. Now, this is key to kind of my bearish thesis, and why I think there's the risk reward is really for the bigger trend is to the downside, and that's because we have a huge long extended negative divergence. Each one of these pops that the Fed has created, and don't be mistaken, the rallies that we've seen since we broke the trend have completely been induced by Fed manipulation. The Fed is pumping money, dropping rates. They're doing everything they can to prolong this thing, as well as the administration. But ultimately, it's not the economy is not creating sustainable growth or strength right now. The economy is losing momentum, and the market is being pumped by stimulus essentially. So, but each one of these rallies are continuing to extend the negative divergence. You can see even in 2020, so 2019 made a lower peak in the RSI, 2020 a lower peak here, and price is higher, a divergent high in price. So you're making a high price, lower momentum, higher price here in 2020, lower momentum. So these are high probability areas to fail. When you make a higher price on lower momentum, that's the high probability areas to fail, just like I've shown you, kind of in, the past. Now, yeah, this could be the negative divergence is not the be all end all. Like it, back here in 2000, we started in 96 and it continued up another 100%, but the trend wasn't broken. You had a trend that remained intact. So it told you, yeah, it's negative diverging. There's loss in momentum is starting to fade. But the trend is still intact. Not the case anymore in this rally. Here's your trend, and we broke the trend. The trend is broken. Negative divergence. So it's bearish on the bigger patterns. Yeah, we can go higher. We can run up into a back test of this 370, and that would, possibly start to burn through some of the divergences. That's possible. The Fed might be trying to do that, create a, burn through the divergences and create some sort of higher high, like way up here in the RSI, and create a new trend, but they haven't done that yet. So as of right now, with where we're at, we have a bearish posture in the larger time frame. And so what I see as this big pattern over the last couple of years is being just a big topping pattern where the market comes down, the Fed pumps it up, the market wants to go down, the Fed pumps it up, and how much more does the Fed have to do? I mean, first off, look at where we're at now and look at these last two sell-offs. Where did the Fed really start to pump the market higher or try to save the market? Well, they did it back here in 2018 near the lows after you got the sell-off, and they did it down here in 2020 after you got the big sell-off. The Fed pumps the market up. They don't pump the market higher. They pump it up from a deflationary event. So if you're banking on the Fed, don't fight the Fed. That's what people say. That's kind of the bull's argument. Don't fight the Fed. Okay, that might be true. But what that means is, I take that as don't fight the Fed when you're down here, right? When you're down here and the Fed's going crazy, printing a bunch of money and trying to stimulate the market, then maybe you don't want to fight the Fed down there. Up here, I just don't see it. So keep that in mind that this is some bigger picture stuff, but I wanted to point out this big negative divergence pattern. I haven't really pointed it out on my channel before on this monthly chart. And to me, looks like we're in a divergent high right now. This is the monthly chart. We can be up here for months, and I'm putting out videos every single day. So when you have 80 or 90% of people that are potentially bullish, retail people at least, and you're up here at the highs and it takes months potentially, I'm going to hear about it a lot, but doesn't mean that we're just all of a sudden in a brand new bull market and going to rip higher and start a new secular bull market. So keep that in mind. That's a bigger concept. Takes time to work its way out. All right, and then this one is the trade idea, Wayfair. Very common to a lot of these other internet stocks that just had kind of they all got pumped up based on the pandemic and the stay-at-home kind of trade. And I think that momentum's starting to fade. I'm seeing signs that it's starting to fade. So now we're looking to short this stuff. And that's why like DraftKings, is the same concept. And that played out for a 25% downfall from the highs. And probably a lot more to go, but it could easily, have a little bounce and then continue to sell off. Wayfair's another one of those. So here's what we got in this one. This is the hourly chart, and we'll start with the daily actually. So here's your daily chart. I see this uptrend right here. We had this initial uptrend. It was not that great, but we created this secondary uptrend right here. Lots of reactions. We traded up here. We recently broke trend, and we've just been doing these kickback rallies. It's very similar to like PHM and some of these other ones that they just don't want to give it up, but it's trading below trend, and so it should get rejected. Starting to lose some steam too. You can see right here, this is the most objective area at the trend line to short, and we're off that a little bit. So that is, there's higher risk because it is off from the high now, up around 15%. If we get another pop up there, that would be a great area to get short. And that would potentially make a marginal new high right here. So let's say we get a new pop all the way up here and make a new marginal high. Then that's the area that is the most objective to short this thing. I don't know if we'll get it, but that would be a good area. Now, and this thing can move quick. I mean, it can move 5-6% in a day. These things run. If we don't get that, and maybe this was potentially the high right here, then if you look here at the daily, big negative divergence right here on the daily. You can see we made a high in momentum back here in April, and then momentum has been fading ever since, and price has been impulsively moving higher. So that tells you negative divergence is in play. You look for a break in trend. There's your break in trend right there. So there's your sell signal, basically. That is where you'd originally take a short position, a starter short maybe, and then kickbacks to resistance are objective areas to add. So you've had a couple times, you've had several opportunities to kind of add to the trade, building a short position. I think this thing fades, and I think it heads down to gap fill. Here's your gap, big gap right here. I think we gap fill down here at 136.05. That's an objective target. And from where we're at now, that is a drop of about 54%, 55%. So I'm looking at that one. That's interesting. There might be something there. So I'm gonna, we'll see how that how that trades next week. Also, if you look, relative weakness in this stock. So that's another bearish sign. You can see here over the last couple days, it traded basically sideways to down. It was sideways, closed down, closed down. The last couple days we were closing down and selling off. Friday down to about 2.5%. Meanwhile, tech, or large cap tech essentially, was moving up in the last 3 days, up, up, up. So it was a FANG trade, but the smaller guys, which Wayfair is a retail, it's a tech company, online retailer, they're selling off, and so I think this online pandemic kind of trade looks to start to be unwinding, and there's a lot of hot air in these things, a lot of opportunity to the downside. So that's a trade idea. I'm gonna point that out. I'm gonna get this video out. Everyone have a great weekend. Bye.